This is Mitch, and welcome to the Real Estate Investor Summit podcast. I'm here with Marco Santarelli, and he's in a beautiful California. Look at that backdrop. He's going to talk to us about turnkey, selling turnkey rentals to people who want to create a rental income portfolio. And we're going to get right to that, but right now I have to pay homage to my sponsor, taxfreefuture.com. If you don't have a self-directed tax-deferred or tax-free investment vehicle, please check out taxfreefuture.com. You don't have any idea the size of the tool you're missing in your tool belt. Being able to grow your investments with tax-deferred or tax-free growth is monumental. Go to taxfreefuture.com, watch the 37 videos. You will not believe what your financial advisors are not telling you. We're going to tell you what they're not telling you, and we're going to tell you why they're not telling you, and it'll all make perfect sense. All right. Got that out of the way, Marco. How you doing today?
Excellent, Mitch. I'm here in sunny California. It's a beautiful day. I'm talking with you. What could be better than that?
Yeah. So, how long you been in the biz?
Well, it depends on how far you want to go back. I mean, I bought my first rental when I was 18 years old. I bought a rental, fixed it up, leased it, managed it myself, held it for a number of years, and it was more or less
7 years. So about 7 years, huh?
about 7 years ago. I'm not going to say how many years, but it was a long time ago.
Okay. All right. And so you bought your first rental at 18. That's pretty good. I didn't buy my first rental, but I bought my first little condo to live in myself, which ended up turning into a rental by the time I was, I don't remember, 22 or 23. But nice to get off to an early start, right? Kind of opens your eyes early to the good and the bad. So.
Yeah, getting started early, when you have time on your side, it's a huge advantage because you have the ability to let time work for you where you have appreciation and equity growth in your property. So the earlier you start, the better off you're going to be in terms of cash flow and equity growth. And the lessons you learn, you're going to make your mistakes early if you're going to make some, and everybody makes mistakes. But if you have good mentors, you're going to learn from people like yourself, myself, whoever it may be, and avoid making those mistakes, and it accelerates your success path. But really, I didn't put the pedal to the metal until the early 2000s. So, I kind of dabbled with real estate knowing that I love it. But I started at 18, but really it took off for me in the early 2000s.
Yeah, same story here. And started early. Then the light bulb really didn't go off till 1996, till, I was in my mid 30s. And then I looked in the mirror and said, what the hell are you doing? All the money's over here. So I jumped in. So tell us about the offering properties turnkey. Tell us about that strategy, because that's what you do. Or am I got that right? That's primarily what you do. Well,
personally, I'm a real estate investor and a serial entrepreneur. When I got back into real estate investing in a bigger way in 2003, 2004, I was buying a lot of properties. In fact, I bought 84 units over 2,000 miles away from where I was living in Southern California. And I bought those in a 9-month period. So I had accumulated a large portfolio in a very short period of time, putting together the systems and the teams that I needed to work with that were literally over 2,000 miles away. I was buying in Florida, Georgia, and Michigan. And so in the process of doing that, investors were coming to me saying, hey, can you help me, coach me, mentor me, whatever it may be. I didn't have the time to do that, but that's when the entrepreneur inside me recognized a niche, an opportunity. The light bulb moment went off, and I realized, hey, there's a lot of people out there that are spending literally up to $35,000 at that time in education through these different boot camps and seminars. And I was part of that as well. I went to those same boot camps, but they still weren't pulling the trigger. They were learning the information, but they weren't really ready to pull the trigger, and they were looking for deal flow. And I said, hey, you know what? I'm looking at a lot of deals. I'm underwriting and doing due diligence on a lot of deals that I'm not buying. Why don't I flip them to you? And so initially I was charging them in the early days to just assign them a contract. And it wasn't really wholesaling because these were already cash flowing properties. But I thought, well, hey, why don't I flip this on its head, become a broker, and set up a model where I'm going out, researching the markets, finding the neighborhoods and the deals, and putting the teams together. And I will give you what is now referred to as turnkey real estate investments within this framework of a turnkey real estate investing system. And I marketed the crap out of that word turnkey. Like now everybody uses it. You see it on, online forums and whatnot all the time. But I was really the one who marketed the crap out of it and made it a kind of a household name. So that's how the business was born. Investors were coming to me saying, hey, I need help.
Wow, so that's neat. I always wonder who comes up with this stuff. I've come up with a couple of things like the OFV, the owner finance value, which is but everyone has the ARV and the Mayo, the word turnkey hasn't been around all that long as far as starting when you're an 18, but it's certainly known now. So I read you're in 22 markets. Do you care to discuss what states or what markets you're in?
Yeah, definitely. Well, in an ideal world, I would prefer to only be in 6. 3 markets that I refer to as growth markets, and 3 markets that I refer to as just your boring cash flow markets. But the reality is, and I know you know this living in San Antonio, but I'm sure you have your ears to the ground. Inventory is very tight. There's diminishing supply, strong demand for rentals. There's a lot of investors out there wanting to get into this asset class and move away from other types of assets such as equities and whatever else. So what we've been seeing year over year is a diminish in supply. So it's harder to get rentals in the markets that we've been in for many, many years, such as Atlanta, Georgia. And it's forced us to go wide, meaning more markets. So we have enough inventory for our clientele, our investors. And so it's grown from 6 to 8 to 10 and ultimately to about 20, 22. Now that doesn't mean we have inventory in all these 22 markets all the time because it ebbs and flows. But the reasoning for the larger array of markets is just to have enough inventory in the various markets. And again, it's a good mix of growth and cash flow type markets. You're in Texas. Dallas has been on fire for the last 4 or 5 years. Same with San Antonio, Austin especially. These have been in the past perennial cash flow markets, but now they've become in the last 4 or 5 years very strong growth markets. So you still can get the cash flow, but less so. And this is why we've had to expand into 22 markets, is because markets change. All real estate is local.
Yeah. So it seems like in the last 6 or 7 years, the whole world's become a house flipper. There's someone on every street corner. There's a seminar, if not 3, being given every weekend somewhere, locally. And it's been as tough as it's ever been. I'm still going to buy 120 houses this year, though. And out of that 120, I'll probably sell or finance 80 of them. And then on 30-year mortgages, and then I'll retail like 30, and I'll wholesale like 10. But it is tougher. I can see why. I mean, I just got my city of roughly 2 million people. I just decided to roll up my sleeves and just become the bear in the room. Like I just got it down to a science. I have a good team. It was hit and miss. Tried a lot of different things. Finally figured out what works, and then it'll change. It'll work for a while. You find that it works for a while, and then you gotta.
Well, what I'm doing personally is built on a simple principle that's been around for decades, if not hundreds of years, and it's simply buy and hold. That's it. It's buy prudent investment properties.
I was talking about finding those deals in those markets. So
I see.
Down to a science, finding those deals, and then it'll go for a while, and then it'll change.
Yeah.
You know what I mean? It'll change.
Well, yes. So there's 2 dynamics there. One is supply and demand, as I was just talking about. When supply is constrained, especially when demand is up, it's going to be harder to find that inventory. So yes, it makes it challenging to find inventory or get inventory in a particular market that you happen to like. But the other dynamic, which is more of a macro level type of dynamic, is the economics of a market and how a market changes. Every market goes through 4 different market cycles. So depending on what market cycle you're in a market will determine the strategy you should be using or whether or not you should even be in that market. So in a market that has come out of a decline and is now, in an accumulation phase, you're going to find lots of inventory. There's a lot of, a lot of sellers out there, a lot of inventory. Your strategy is you can get in at a low cost basis. So your cash flow, your cap rates, your cash on cash returns, they're all great. But when a market has appreciated for 5-6 years, year over year, and it's now become a much more expensive market, your returns have dropped, and inventory is going to drop too. So your strategy is going to shift. You either have to leave that market, or you're going to be doing something different. You might go from buying distressed properties from distressed sellers to, let's say, new construction, like build to rent type product. It really depends on the market cycle within that market. And we're in a country that's so big. We have over 400 metropolitan statistical areas. What happens in, let's say, San Antonio, Texas is different than what's happening in Detroit, Michigan, which is different than what happens in, let's say, Indianapolis. So you have to understand the market and the market dynamics and the market cycle in order to determine your strategy there.
So, what kind of margins do you have to set up for these turnkey investors? What kind of numbers that you have to give them? Are you selling them houses at 70% of their value, or at a 10% cap rate, or how do you price it?
Well, let's step back for 1 second here and understand the two roads that an investor goes down. They either choose the active or the passive role. If they want to be an active real estate investor, it's someone who's putting in a lot of time and energy and effort, building the knowledge, building the team, spending the time, maybe meeting with sellers, prospective sellers, negotiating. They're picking up a hammer or managing a crew. They're fixing a distressed property. I mean, they're actively involved. It's taking time, energy, resources, et cetera, et cetera. You can create your own wealth and equity that way up front immediately, because you're creating value. At least if you do it right, you hopefully will create value. The flip side of that is a more passive role. And that's where you're finding a performing asset, a property that's already leased, it's cash flow positive. And I call that just simply a rent-ready property. You can find some of those on the MLS. The alternative is you work with a team and buy a turnkey rental that is ready to go today. And there's nothing you need to do. There's no deferred maintenance. There's no CapEx expenses. It's professionally managed. It's tenant occupied. You're just adding one property after another to your portfolio, and you're cash flow positive from day one. That's what a lot of people choose to do, especially professionals, because they're limited on time, but they got the cash and the credit. So when you're looking at your returns or your margins, as you're calling it, what you're going to find is that with turnkey rentals, you're typically buying at or slightly below market value. Now, 5 years ago, all of them were below what you would call appraised value, just because there was a lot of inventory. But today it's tight, and sellers can get at or slightly below fair market value for those properties, because there's strong demand and they turn over very quickly. So kind of a roundabout way to answer your question is, generally speaking, when you're buying turnkey rentals, depending on the market and the neighborhoods, you're going to buy at or below market value, but there's not going to be like a large quote unquote discount. If you're doing the work yourself, if you're finding it, negotiating it, maybe creating value by doing value-added repairs and upgrades, then you create more equity on the front end. Now, keep in mind, we're talking about paper numbers here. These are numbers on paper. It's the appraisal, it's market value versus your purchase price. But when you look at your rates of return, like in terms of cap rates, for example, I don't know what your listeners measure their returns in, but in terms of cap rates, they're going to range from 6 to 7 on the low end to 9 to 10 on the high end. Of course, if you're leveraging your investment, your cash on cash return is going to be 7, 8, 9% on the low end to the low teens on the high end. Just is really based on the market. Like Huntsville, Birmingham will give you much higher cash on cash returns than the market like Dallas. So I'm not sure if I'm answering your question there, Mitch, but
No. It was a good discussion. So people are buying these properties. Why do people buy turnkey properties? I think I have some ideas, but what do you say?
The biggest reason is because they have a career, they work full time, they have a family, they have their hobbies and friends, they have a busy life, and they don't want to reinvent the wheel. They don't want to go through the education and the learning curve to learn everything they need to know. They don't want to have to find all the people and the resources that they need and vet those service providers to build the team in order to identify the markets, the neighborhoods, the properties, acquire the properties, manage the properties, do the inspections, get the financing. When it's already put together and packaged for you and all of it is available for you on a silver platter, quote unquote, it just saves a lot of time.
It's not as easy as they make it look on Get Rich TV.
No, it's not. It's not. Absolutely not. And The thing that drives me crazy about a lot of those shows on HGTV and those other programs is it's reality TV. They make it look fun and sexy, but what they don't show you is all the pain and the mistakes that happen and the losses that some of these guys take. It's a lot of it is scripted, and I know because I know some of these people that are on those shows. They're friends of mine, and you know, there's a lot of deals where they lose money, and I do the same thing.
I know for firsthand because one is it was between me and another guy for San Antonio, and A&E followed me around for 3 weeks, and then I saw these houses in my town that they said they made this money on, and I saw it go to auction. I know what the problems were. You know, I mean, it didn't ever sell. That was completely fabricated. And I also know that, you know, when I was talking to the people there, they were asking me if I could buy and sell a house every 6 weeks. And I said, man, if I bought a house and didn't have to even shampoo the carpet and I had a buyer the day I bought the house, mortgage companies can't close a loan in 6 weeks. You know what I mean? So, I mean, I don't know what they said. Don't worry, we'll fix it. You know, so I'm like, I don't know if I want to even be part of this, you know?
Right. But that goes back to the active and passive approach. Those are active real estate investors that want to roll up their sleeves and be hands-on and do the work, find the deal. They're in it knee deep. Whereas,
to tell you the truth, you know, I offer 8% rate of return if you just loan me your money. You know what I mean? Yeah. Just loan me your money. I'll give you a first lien, and I won't let you in over 65% of the value. You know, most people, that was better than what's going to happen to them when they go out there. Not to mention the amount of money you need to spend on the education or whatever. I'm not saying, you know, I offer education, you offer education. I'm not telling anyone not to do that, but I'm also saying there's certain people in the world. What's the matter with a straight 8% with a minimal risk? You know what I mean? And backed up by a real piece of property that's worth more than you got in it. What's wrong with that? And that's passive. And keep your life and have a life. I mean, when you and I started, we probably did the same thing. Tell me, I had a job and was trying to I was burning my candle at both ends, trying to get free of my job, doing this every spare minute that I wasn't at my job. And
yeah, absolutely. I mean, there's 101 ways to make money with real estate. You know, that's just a known fact.
Bless America.
Yeah. I mean, if you want to be extremely passive and just be a note investor and make 8% on your money, you know, not even worry about it, just sleep comfortably at night, great. Invest in notes. You know, you can invest in notes for 6, 7, 8, 9, and 10%.
But another reason why people do what you do is they don't just want the income or the potential income. They want the depreciation and the write-off.
Exactly.
Because they're probably high net worth individuals, right? And they're getting smashed on the taxes.
Yes. Yeah. The depreciation's huge. But again, you know, like if you're a note investor, you're making interest income. It's one dimensional. There's nothing wrong with that, but you're never going to create wealth over time. Your net worth is not going to increase because you have no equity ownership and you can't participate on the upside. So there's a different strategy for different people at different times. You just need to know yourself, where you are and what you're looking for. And that will determine the path you take. A lot of people don't stop to ask, well, what is it I'm trying to achieve? You have to have an investment philosophy and an investment strategy in order to make a plan.
Yeah. So look, I want you guys to go to reinvestorsummit.com/passive RE. And there you can get the 10 rules of successful real estate investing as pinned by Marco Santarelli. You can also get the ultimate guide to passive real estate investing over there, which is the prelude to the actual book that should be coming out any moment now. So by the time this gets aired and gets posted on the podcast, they're probably pretty close. But anyways, whoever downloads the guide will end up getting the book whenever it's finished. Okay, so if you go get the ultimate guide to passive real estate investing, you're going to be in line for a copy of the book. And that's a digital download. Correct me if I'm saying any of this wrong, Marco. But if you want the hard copy, he's willing to give you the hard copy if you've downloaded this guide. All you have to do is pay for postage, which is completely fair because sending these books to free would break a man if you didn't charge the postage. I mean, so don't think it's some kind of scam or he's making money off the postage. That's ridiculous. But
no.
So again, reinvestorsummit.com/passive RE for real estate. And so Marco, what's the difference between being rich and being wealthy?
rich is a big chunk of cash that you're sitting on. It doesn't necessarily mean it's doing anything for you, but you could say, hey, I've got $1 million in the bank and that's it, end of story. But when you talk about wealth, you could talk about wealth in many different ways. You could talk about it in terms of your health. You could talk about it in terms of finances. But for me, if you, financially speaking, when you're wealthy, you actually are measuring it in terms of time. How long can I live and survive and live my lifestyle based on my investments and whatever I have as my net worth? So if I have passive income, if I have a check coming in, it's not a check anymore, it's auto deposit, but if I have like $5,000 of passive income coming in from my rental portfolio each and every month, I know that I can live virtually in perpetuity off of that income because I've got all my expenses covered plus some extra to go travel or do whatever I want. So when you are wealthy, you are essentially living month after month, year after year on time. I'm measuring wealth in terms of time, not a chunk of cash. So if you're rich, you could have $100 million, but what are you doing to turn that into passive streams of income where you can survive and also pass along to your children or your heirs? So that's really the difference. Wealth is measured in terms of time, whereas just being rich means you have a lot of assets. Could be a lot of cars, could be a stack of gold, it could be a chunk of $100 bills, whatever it is, but that's not cash flow. So think of being wealthy in terms of cash flow,
Okay, that makes perfect sense. So I've heard you use a word that I'm intrigued by. What is a market agnostic, and why is it important to be one?
I'm glad you asked.
I mean,
so
I had never heard that term before.
So being market agnostic means that you're not tied to or married to any one particular market. A lot of investors make a mistake of thinking, and this comes from the gurus, the so-called gurus that you may love or hate, where they're teaching you how to be a house flipper, and they say, hey, don't do anything outside of a 1 or 2 hour radius of where you live. Well, that's okay if your market makes sense for the strategy you've chosen, which is to buy, fix, and flip, or buy, fix, refinance, and hold properties. But for a lot of us, like me, living here in Orange County, California, to find a deal anywhere in Southern California is virtually impossible. So to be married to your local market is flawed advice because the deals are just not there. So when you are market agnostic, you're not married to your local market. You realize that you have a fixed amount of investment capital that you need to put to work, and you want it to work as hard as possible for you. The best way to do that is to find the markets in the United States that are going to give you the best returns in terms of cash flow, in terms of upside potential, and the stability of the market to minimize any potential downside risk. When you're in a cyclical market like I live in here, coastal California, we have strong ups and strong downs. So I don't want to be on that roller coaster ride down. This is why this is not a market to invest in, one of many reasons. But if I go to a market like some of the Texas markets have been over the last 5 years, I could have had strong cash flow, good upside potential, and minimal exposure to downside risk in terms of price depreciation. You can only do that if you're market agnostic. If I do my research and I say, of all the stocks on the stock market, Coca-Cola is by far the best buy, and I have to buy it today because it's a killer deal. Their corporate head office is in Atlanta, Georgia. I live in Southern California. Am I going to say to myself, I cannot invest in Coca-Cola because I live in California and the head office is in Atlanta, Georgia? That's absolutely stupid. This is being agnostic. You're not married to the market. You're not going to make your decisions based upon where you live. You're going to make them based on prudent, objective, financial, mathematical decisions.
I will say that I have taught to stay local, keep it close, and become an expert in your tiny little mecca until one of two things happens. You get really good at what you do, and you're equipped to go out further and take advantage of another market because you've learned all the lessons. Now it's hard enough to learn lessons sometimes in one city, much less multiple cities. I made that mistake myself. The other thing is if your market dries up or it just gets to where you can't do anything, then you have to go someplace else. I teach a lot of students, I say a lot, my fair share of students who have to go do business from afar because where they live is not going to work. New York, parts of Florida, almost all of California and a lot of Oregon. And it's not just economics. Sometimes the laws per your strategy don't work so well in certain states. There's states that got regulation on how much interest you can charge on a homestead.
Yep.
There's states that make it very difficult for you to get someone out of a homestead if they don't want to go, i.e. Florida is like killer on that deal. You know, trying to owner finance in Florida, you can do it and there's ways to do it, but it's different than how I do it in Texas for some reasons. You know, Texas and Georgia have the same exact real estate laws, foreclosures and everything. I don't know if you knew that. Now,
No, I didn't, but that's great to know.
Talk to the people in Georgia, they'll tell you that the Texans copied them. And if you talk to the Texans, they'll tell you the Georgians copied them. So
Right.
I'm going to set the record straight. Georgia copied Texas, okay?
Okay. I love it. That's great.
But you know, the foreclosure process is the same. We have some of the fastest foreclosure in the nation, 45 days if you hit the timing just right, but you never do. So just count on 90 days for foreclosure, you know, I mean, generally. Of course, if someone files bankruptcy or doesn't want to go and lawyers up, then, you know, you're in for a little bit longer haul, but that's just the price of doing business. It happens to me once or twice a year. And, you know, instead of making a kabillion, I just make a kabillion and a little bit less. That's all. So,
Right.
you know, you hand it to your lawyers and say, call me when I got the keys, you know, and don't stress out over it. Just another day in a life, you know.
Yeah. So the bottom line is you actually you kind of emphasized or underscored the you know, what I said about being market agnostic. The thing is, you have to fit the market to the strategy you're involved in. You know, my understanding of the strategy you take, it helps to be local if you're doing all the work, because you're the one that is negotiating the deal, meeting with the sellers, and doing all that stuff. So it of course it's going to help you tremendously to be local unless you have a team elsewhere. But if that stops working, you either have to move or you have to, you know, move your market and have the boots on the ground and the team to help you in another market that actually does make sense.
I've put it like this, and because the mind and the human body is the most adaptable thing in the world. You put its back up against the wall, it will raise to heights you don't even know. You know, so just imagine, people say, well, I'm afraid to do business out of town. Just imagine you're confined in a jail cell and you have internet access and a phone, and you've got a family out there. You're going to figure out how to do business. You're going to figure it out because you're not going to have a damn choice. You know what I mean? So you're going to, and you may end up being a multi-millionaire from that cell.
Yeah.
You know, so we rise to the level that we put our back to, you know what I mean? And so if you're afraid of that stuff, there's people out there that have already conquered it. Just go get around them, you know, and Mark might be a great guy. So do you have mentoring? Tell us about your mentoring. What do you have?
You mean for a mentoring program?
Do you have a mentoring program, or do you teach people?
Shamelessly, I'm going to say no, I don't. I really don't have, at least today, anything between free education and providing all the, you know, resources and properties that someone needs. So that path in between is completely bare. However, in 2020, there will be a book, and there will be an online training program, and possibly a mastermind or coaching program. So these are all things that are in the works now and being built out for next year. But today, I don't have anything to sell in terms of education.
That's fine. I mean, I'm not pushing for that, and for the audience, I'm sure loves that about you. You know, you're not selling anything; you're just giving freely of your own will here. You do have a podcast, right? So you guys, I want you to go to REInvestorSummit.com if you're interested in Marco Santarelli's podcast. Go over there, check it out. I'll have the links to that. What is your podcast centered around? Like mine's centered around real estate, entrepreneurialism, motivation, and inspiration. So if you fit any of those four categories, you're welcome to come on the show and we'll talk. What are you focused on in your podcast?
Well, I do talk about some of those topics, of course, but more broadly speaking, we talk about, at the highest level, real estate investing from every angle, from asset protection to financing to market cycles to strategies, identifying markets, identifying neighborhoods. But there is a focus or a bent towards passive, not active real estate investing. So because we really don't want to heavily promote someone pick up a hammer and find distressed sellers or distressed properties and start, you know, doing the whole HGTV thing that they see on television. We really want them to build a passive income portfolio. That's the bottom line. We want you to be financially free. And the way to do that is to build enough passive income through whatever asset classes you want. But for me, I love real estate. So I want to encourage, inspire, and educate people to build up units of passive income in real estate. That's the bottom line.
No, that's good. So again, go to reinvestorsummit.com/passive RE. Get your 10 rules of successful real estate investing and get your guide to passive real estate investing, which will also lead to a full-fledged book in the future. And I don't know, anything else you want to say maybe before we wrap it up, Marco?
Yeah, you know, for a lot of people, they educate themselves, they become very well educated, but they fail in execution. You know, nothing happens until you take action. You can be the most educated wannabe real estate investor in the world, but until you actually put the rubber to the road and start taking action, you know, nothing's ever going to happen. Success all comes out of execution. Execution is absolutely everything. So take action. I see a lot of people wish to be rich, want to be rich. They educate themselves. They dream about it, think about it, talk about it with their friends, but they never end up, you know, picking up that phone or going online and doing the research or start analyzing properties or even writing offers, you know, whatever it may be. Take a step, take a baby step, and then take another baby step. And you know what? By the time you realize that you've taken 10 baby steps and you've taken one giant leap forward, and all of a sudden you're like under contract for a great rental that's going to give you $300 a month passive income. And guess what? Do that again and do it again, do it again. Before you know it, you're going to be, you know, financially independent and ultimately financially free.
Yeah, you don't have to make great big deals or set the world on fire. You just need to do one and, I don't know, get a wholesale profit or get a little positive cash flow and be able to wake up in the morning, look in the mirror and do your Rocky dance and say, hey, I did something. I did it. No.
Along with those raw eggs.
Yeah, eat those raw eggs.
Yeah, that's great.
Go beat on a side of beef somewhere in a cold house.
I love it.
All right, so I'd like to thank everybody for stopping by to get you some Marco Santarelli. Be sure to get over there to reinvestorsummit.com/passive RE. Get the podcast. What's the name of your podcast?
It's aptly named Passive Real Estate Investing.
Oh, there you go. Well, that's really hard to remember. So do that. I want to thank taxfreefuture.com for being the sponsor of the show. Please go to taxfreefuture.com. You will not believe what your financial advisors are not telling you. And we'll show you what they're not telling you, and we'll tell you why, and it'll all make sense. There's 37 little video vignettes there if you sign up for them, and they're all short and sweet and very intriguing. Learn how you can grow your real estate investments tax deferred or even tax free, or you know, for all practical purposes, tax free. Don't split hairs with me here. Nothing's free. All right, Marco, thank you so much, man. And you ever make it to San Antonio?
From time to time, I do. Haven't been there in a long time, so I think I'm overdue. But yeah, I'll definitely look you up and hook up.
Will you please look me up when we get done here? I'll give you my information, or if you don't already have it. Appreciate it. This is Mitch Stephen with realestateinvestorsummit.com. We're out of here.
Thank you, Mitch.